Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan, and this is the second video in our newly launched Wise Beyond Bitcoin Macro Outlook series. We are going to be taking a look at what's going on with monetary policy, the Fed, inflation, unemployment, supply chain issues, on all the above, trying to figure out what's going on in the macro picture in order to draw some kind of conclusions about what to expect with financial assets in general and crypto markets specifically. So that's kind of the focus we're bringing to this series. So let's hop right in. Before we do, I want to mention this is not financial advice. We are not financial advisors. Keep your own vices. We'll keep ours. Do your own research. We make mistakes, and we don't want to try to tell you that this is, the truth or some kind of objective, anything objective. It's all, we're doing our own research, and we're trying to find the best answers in a complicated picture. So take this with a grain of salt. So going into what's going on today, the Dow, the Nasdaq, the S&P, all in the green. Looks like around a little over 1% on the S&P and the Nasdaq, and the Dow's right around 1% as well. So it's good to see things in the green after yesterday. A pretty ugly sell-off in the markets. One of the big stories is the Nasdaq has broke into correction territory, and today it's sort of recovering a little bit from those lows. But the key point is that it did kind of break into correction territory, down 10% from its highs, and so there's something to consider there. Gold is up, elevated, 1840 in the 1840s. So it's continuing to climb and reflecting that 7% inflation number. So let's unpack some of this and get into the details a little deeper. Let me go to a different article. Okay, here we go. This is Bloomberg. We're talking about kind of what's going on with the bond market and what's going on with earnings season, because we are in earnings season. This is when companies report their profits, their revenues, and we get to kind of get an understanding of how, what's their profitability looking like with raw numbers. Instead of projections, we're actually seeing what happened. So it's backward looking. But by getting that backward looking data, we can then make better judgments about what to expect going forward. So it's very important. And the general takeaway is that earnings have been beating expectations or right at expectations. So that's good. And you would expect that in an inflationary environment where there's a lot of money chasing too few goods. So if you're selling things, you're making, you're probably charging higher prices, and whether or not that tracks to greater margins or not, that's going to depend on the firm and the company and the market they're in. But generally, you can see that nominal revenues are going to be higher in this sort of environment because there's a lot of money chasing a lot of things. There's a lot of money in the system, right? So that's bullish, and that's part of why you're seeing the market recover today, is earnings. The other story that's going on here is that we had just kind of gone through a bit of a bond sell-off, and this is global bonds, sovereign bonds. This would be like your treasuries, right? Your government debt. And what happened was, during a sell-off, is that interest rates rise, and one of the key metrics is the 10-year treasury bond, and it had almost hit 2% a few days ago, and it's come down from that high, and that's part of the narrative today with why things are going up. The drop in interest rates is very bullish. Bonds are interesting. So as interest rates rise on the bond market, that means the price of bonds falls, because there's an inverse relationship between price and yield with bonds. So the bonds yields rising like they had, that's a sell-off. That's a price fall. So the yields rise, the price falls. So if you had been investing in bonds, you had bought an asset which had just had dropped in its value, its price, and even though the yield was rising, you're not happy about that. So people don't like a bond sell-off. That's not a good thing. So that happened a few days ago up till yesterday, and now we're recovering from that. Yields are falling. Bond prices are going up a little bit. The 10 years at like 1.86, I believe, and so it's definitely kind of like a painful moment, but we're seeing a little bit of a retracing back to some normalcy. We'll see if the bond sell-off continues later on, or if the if the as the rate hike, as we see these rate hikes continue, or we'll see if maybe the growth in earnings and other elements of the market keep things optimistic enough to where that people are not selling off their bonds. So we'll see how that works out. But it does pose a question: is will it go higher? Will it go lower? It's unsure. But I think most people consider that in an environment where the Fed is changing policy and hiking rates, that we probably will see more sell off. We haven't seen the last of the sell off. That's the thinking, whether we're talking about stocks or bonds. All right, now let's take a look at the Nasdaq a little closer, because that's a heavily tech centered index. It's of stock companies that are in tech. That's mostly what the Nasdaq is, and we're seeing that from the Wednesday sell-off, there's been a little bit of retracing in Microsoft and Google and Facebook and some of the big tech names. Now it's interesting because those are some of the companies that have done the best in the last during this cycle, and the thinking is that these are some of the more risky. Tech tends to be very, very risky. Kind of doesn't do so well during recessions, during corrections. It'll lead the market and beat the market during a bull market, but it'll probably do worse than their average holding during a bear market. So what happens to Nasdaq is a bit of a kind of a canary in the coal mine, if you will, for how what we can expect going forward. All right, so we've kind of touched on what's going on right now today. And we're going to leave these articles we'll leave these links in the description if you want to go back and read more details about specific companies. But I don't really feel like that's important. We're trying to look at the macro the big picture here. So what's going on in a macro sense, right? So there's a few articles that came out yesterday that I just want to run through real quickly, because they have some really good points that I think stuff that kind of harmonizes what we've been saying ourselves, right? And this is the main takeaway from here, is that the thinking is that the Fed would have to, in order to really stop inflation, to fight inflation, that the Fed would have to hike rates or raise the rates to nearly 6%, and that's a large number. I don't believe, my personal opinion, that's on the table, because of the fact that at those rates, the Treasury would have to, this gets into it right now, is the thinking is the Fed could not go that high because it would create so much deficit spending as the Treasury serviced the bonds that it owes, right? As the payments, the coupon payments that it makes to the Treasury holders would go up. So the servicing costs go up massive amount at these rates of interest, and that's not going to be offset by tax revenue, because so it's going to have to be papered over through deficit spending, and that essentially means more money that's money creation. That's inflationary. That increases the supply of money. Okay, so then we got this problem where we're trying to fight inflation, right? So we're raising interest rates, but by doing so, we're creating this need for deficit spending, which is mathematically certain, right? This is not a choice. This is just what happens, because those bonds have to be, they're going to have to pay those servicing costs, right? And it's contractual. So there's no choice here. So the deficit spending becomes automatic. And then what the result is that I have more money than circulating into the economy, which puts more upward pressure on inflation. So you get a bit of a box, kind of damned if you do, damned if you don't sort of thing. And this is something we've said. It's almost like they've been watching our channel, but we've mentioned that there's really a limit to what the Fed can do in terms of raising rates because of this debt service problem, right? And if that's the case, the thinking is that we're probably going to be continuing this QE path, right? That we're just going to have a slight. My thinking is that we'll probably see rates rise we'll see a few quarter% rate hikes, maybe 3 or 4 this year. We'll get to that 2% number, but there will also be a lot of pain associated with that in the stock market and the bond market, and that essentially we're going to just have to switch gears and not pursue this to its logical conclusion, which would be like 4 or 5%. We're going to have to switch gears midstream and probably see another QE or another round of stimulus, another round of easy money, another round of inflating the supply of money driving down interest rates, trying to stimulate demand, trying to get people to spend, trying to get economic activity to generate tax revenue, right? Which makes that servicing issue less difficult to deal with. So the thinking is that we probably will not truly fight inflation in a serious way, that we'll do some half steps, and maybe, and then those half steps will involve, some corrections in the stock market, and the financial assets will fall. So that's not off the table, but the degree it is probably going to be muted compared to what like a 6% Fed funds rate would see. Okay, so that's that main takeaway there, is that there's a bit of a ceiling on what the Fed can do. And the other takeaway here is that, oh, I think that might be a different article. Okay, yeah. This article is what I'm heading to next. So why are we in this situation? The next question is, why are we in this situation? Why is the Fed's got their back against the wall, and why can't they deal with this inflation problem, right? They have all the tools at their disposal. So what's the deal? And it's really because of policy missteps. Like they held rates so low for so long and injected so much money that let me get into it right here, is that they've overstayed their welcome. That's the point here, that they've badly misread inflation and generated a lot of it. And how did that happen? How did they misread inflation? Well, the Fed's been focused on CPI, right? Consumer price inflation, where what's the cost of a typical basket of goods, and that does not factor in asset price inflation, which is the other side of the coin. So if you're generating all this money and pumping it into the economy, but you're only looking at the consumer side, not looking at the financial asset side, you're missing a lot of inflation that's happening in the markets. And if you're only looking at the consumer side, then what happens is that all this inflation happens on the asset price side, and then eventually you realize, oh wow, okay, we have a bubble. Well, the bubble is so high that what's required to unwind it is not possible. That's that 6% interest rate. So the problem is that we've created too much inflation, and that the medicine to deal with that is going to be pretty painful and probably not politically possible, again, considering all the consequences. So this is really just, we'll leave this in the description, but essentially the idea here is that they've put themselves in this position by stimulating too much and waiting too long to start unwinding that stimulus. And what is the takeaway here then? Well, the expectation, and this is my expectation too, is that the markets, and the financial markets specifically, have become addicted to cheap money, low interest rates, QE purchases, monthly purchases of, a few $100 billion of assets every month. They become addicted to that. It's priced in. So the problem is that when we switch gears and go to even a moderate tightening path, that's going to definitely kick off some kind of a correction. Whether or not it's probably not going to happen all at one time, right? You see some moves down, then you see a retracement, and maybe earnings come out and they're optimistic. But ultimately, this policy is going forward in 2022. We will see multiple rate hikes, and the thinking is that this is going to lead to a sharp sell-off. It led to a sell-off in 18 and 19 when the Fed tried it last, and they abandoned that path. And the need for even sharper hikes in rates is greater now, because the problem with inflation is much greater now than when it was in 18 and 19. So the thinking is that markets are going to probably correct significantly the beginning of this year, first half of this year. And then through that, we will have that will essentially lay the foundation for the next easing phase, right? The narrative will be markets are correcting. The sell-off is becoming reflexive. So and liquidations, what happens is you got people who are leveraged, and as those underlying collateral takes a hit because of the sell-off, right? So that their leveraged positions get liquidated, and then that creates a chain of liquidations on the next rung of the ladder, right? For the next group of people who were leveraged. And this just kind of flows all the way down. You get all this destruction of money, destruction of capital. This can create a massive depression. It can be destabilizing. And to get in front of that, the Fed will ease. They will bail out companies. They will buy assets. They will print money. They will reduce interest rates. They will do everything they can to prevent the markets from really correcting in a meltdown. So the thinking is that there will be somewhat of a sell-off, but get ready for the next bubble, right? And in that situation, financial markets will rally like they did after the 2008 housing crisis, right? I mean, if you would have put money in the indexes in 2009, and you know the growth that came for the next decade was like 400%. It was insane. So, and that was driven by QE and lower interest rates. So we're poised for another round of this. So, not financial advice, but now might be a good time to kind of move into cash, take some profits, and get ready to buy the dip. And I don't mean dip in the sense of like a 5 to 10% dip. I'm talking about the dip that's going to make people shift their narratives out of financial assets altogether. And the last thing people are going to want to do is buy stocks or buy any of this stuff. That's when you go buy it, right? You do the Warren Buffett running into the burning building, you know, and buy up all these assets that you think are, I mean, you do your research, make sure you buy sound stuff, buy sound names, or companies that are doing good things, or crypto projects that are doing innovative things. But that's the idea, is you be counter the trend, right? When fear is dominating and all the markets are red and we've lost 30%, that's the time to go in and take a position if you're of that mindset. So I think that kind of wraps up our macro update. We are expecting a bit of a correction, for a deep correction this year at some point, followed by another round of easing, another round of QE, probably even more extraordinary than what we've come to see in the past. And that's not the most optimistic scenario, because we do like sound money. We do enjoy we do believe that sound money helps coordinate economies in a way that makes them grow in a sustainable way. So you can kind of not have this boom bust process, but that's idealistic, and we have to kind of live with the situation, the institutions, and the system as we have. And right now we're in a situation where the money monopolists have exclusive control over these things, because they have a monopoly, right? So there's a central bank with monetary policy, and they make the decisions that they feel will be best to make the system work. And I don't know how you make that any better than what we have right now, except for decentralizing it and creating a market for money, and have many different currencies, and get rid of the monopoly, and let every bank and money producer have their own policy. And if they succeed, great. If they don't, the market will punish them, and their product will fall out of the popularity and won't be around. So we can kind of crowdsource monetary policy that way. I think that's, and then test it, expose it to a test, and I feel like that's a better way. But that's a video for another time. And I hope you like this content. We'll be producing more specifically on Secret Network and the IBC and all the cool things happening there, as well as our weekly macro updates. So enjoy, stick with us, comment, like, subscribe, tell us what we got wrong, because by all means, we are not going to get everything right, and there's going to be lots that we don't see. So thank you for watching. Adios.